Hello everybody. So central banks in focus this week, of course front and centre is the Federal Reserve, but we also have the Bank of Japan and the Bank of England setting interest rates this week. Even some small talk of a cut in interest rates in the US. That is part of what's fueling a pretty strong rebound in equities of late. We've also seen a bit of a rebound in oil prices. The US dollar has stabilized somewhat after a recent bit of weakness, but gold still looking pretty strong. So we'll consider all those markets as we discuss the events coming up in this following week. But firstly, I'll have a look at this economic calendar and some of the other major events for this week. So you'll note that there's inflation data from the Eurozone, the UK and Japan, also Canada, which we haven't noted here. So what's interesting about this is that central banks and economists in general are pretty scared about what's happening, what potentially could happen at least with this trade war between the US and China, but it's not really showing up in the economic data yet. And so they need some excuse to justify the dovish stance many of them are taking. And so what we really want to see from the economic data is some justification in essence for the central banks doing as they have sort of indicated. So inflation being right up there. If inflation data remains soft, then again we look for easier central bank policy, which is good for equities, but generally negative depending on the relative push for it in all these different currencies. Also got crude oil inventories. Of course, this is every week, but I thought I'd particularly note it this week. Since we just hit that $60 barrel mark in Brent, we seem to be trying to carve out a base there. And we had those tanker attacks last week, which put a bit of jitters through the oil market as well. So putting oil front and center for consideration in markets. And then, of course, we have the interest rate decisions, which we'll discuss a little bit more in just a moment. So as mentioned, going into this Federal Reserve meeting, we've had a pretty decent rebound in equities. What's interesting is that it's the Fed that mostly fueled that. We've still got the trade war concerns. We've still got some renewed tensions in the Middle East, for example. The economic backdrop looks fairly soft, but nonetheless, equity markets are moving higher. So a lot of that rests on the Fed and market pricing for interest rate cuts this year. So we're into that kind of bad news is good news in terms of economics at the moment when we talk about economics versus the stock market. A couple of examples of how it seems to be monetary policy that's driving markets at the moment. Donald Trump, that is, of course, the president of the US, tweeted that in fact, he said it in an interview as well on television that if President Xi of China did not meet him at the G20, then he would slap more tariffs on another 300 billion worth of Chinese goods coming into the US. So that's obviously pretty negative of the trade war, yet the S&P 500 closed up around 1% that day. We also had the non-farm payrolls numbers from last week, which were pretty useless. Nonetheless, equity markets closed higher on that soft data. So clearly not the economy, clearly not the trade war seemingly driving sentiment, although it is worth noting that last week we did avoid those tariffs on Mexico, which in honesty not many people thought those were going to come through anyway. All that being said, the market is looking for interest rates in the US to be 2 cuts lower from where they are today in 1 year's time. So in that sense, the Fed sort of has to get moving here to catch up with the market pricing for that market pricing to be correct, which of course it may not be. But it tends to be what happens is that the Fed does sort of move in the market's direction. That's what they've been doing of late because they don't want to cause any big disruptions. So that being said, we don't think the Federal Reserve cuts interest rates this meeting. And so that could be the cause in itself for a bit of dollar strength. That isn't the base case for most people that they cut interest rates. So again, as normal, we're looking at the economic projections, which will be released alongside this meeting. And we want to see what those economic projections suggest about when the Fed actually could cut rates. And of course, the press conference as well. And if there's any hint that it's, say, for example, September, then I think we see some renewed weakness in the dollar and renewed strength in the equity market for the reasons that we just discussed. So of course we have these other central bank meetings as well. Let's discuss the Bank of England. It's pretty straightforward at the moment. The Conservative Party leadership contest is really taking most of the limelight in terms of what Forex traders are looking at to trade the British pounds. We found a bit of a base in the pound. We were talking about this last week as well. It's still holding around that 126 level. We think it holds it for the time being because most of the candidates are still talking about no deal not being the ideal scenario in terms of Brexit. And so still some renewed hope that perhaps we can avert that. What that means for the Bank of England, though, is that we're still in no man's land. What's interesting is actually we've had the like of Ben Broadbent, who's the Deputy Governor of the Bank of England, actually talking about interest rates being higher. So it just seems like the Bank of England are completely out of sync here. They should have raised interest rates a couple of years ago when the economy looked good. Instead, they were worried about Brexit. Now the economy looks a little bit softer, globally at least. And of course, we have the most other central banks around the world reflecting to that kind of reflecting that global weakness and the trade war story. So looks like Bank of England missed the boat, but they're still talking about raising interest rates. So arguably, should they shift their stance from talking about higher rates, that would be soft to the British pound because you've got Brexit and you've got a dovish Bank of England. But for the time being, it doesn't look like they're doing that. So we're expecting a fairly neutral, nondescript meeting that should be probably net positive for sterling if they keep their more hawkish stance they've had of late. Bank of Japan, for what it's worth, Governor Kuroda has said that the Bank of Japan still have more tools in the toolbox if needed to inject more stimulus. It's worth remembering that the Bank of Japan have been some of the most aggressive on stimulus. So if the market's taken at his word, there's some room for some yen weakness next week. Particularly worth looking at euro yen because that's just testing its recent lows and maybe some form of bottom taking place there, especially if we get some renewed risk-on sentiment because people would shy away from the yen as a haven and move into the euro, particularly depending on how dovish the Federal Reserve go. People will move out of dollars into the euro. Right, well that's it for this week. Thank you very much for watching, and if you want to see these videos as soon as they're released, please follow myself and LCG on YouTube and social media.